Alert for the Producer Price Index, PPI inflation. I'm Rich Paz for Critical Point, Tuesday, April 14th, 10:02 a.m. Eastern Time. Today we got the PPI report for March, and it triggered an alert. We had levels that if it goes higher. Now we already gave an alert a while ago on the PPI that we wanted to be bullish the PPI. Okay. And then earlier this week or a little while ago, we got the CPI inflation alert as well. Now believe this PPI, this is what we have today. It's taking out the kitchen high and it's going higher, and our targets begin at 5% and higher. And I'm going to show you some very long term here that may mean this has to go back to 10% later this decade for some reason or other, not necessarily because of what's going on right now. Okay, there could be some big setbacks before going higher still. But here's the time forecast for where we're going for this kitchen business cycle that's higher. It should be higher into 2027, just as I've said for CPI inflation. Now, it's possible it tops out near the end of the year. And if for some reason the Federal Reserve came in sooner and raised interest rates faster, they could kill this and distort it. They could even kill it in the sense of what occurred in the 1970s, and there is some similarities there. So we will watch out for earlier tops than normal, but what would likely happen is it would come down some and then maybe tick up and move sideways a little bit to try to show some evidence of that kitchen business cycle top towards the end of this year to next. Now, a kitchen business cycle is basically about 3 to 4 years. Some data it's more like 2 to 4, but you want to lean more towards 3 to 4 years. And that's actually shorter than what Mr. Kitchen discovered, but I've learned the more accurate version and therefore imply it as the economy and for the stock market and other markets, even in commodities. Now, the kitchen is a throttle up, throttle down process during a decade bull bear market for the stock market and many other markets, but also a throttle up, throttle down process for the economy for the decade-long juggler business cycle when the economy grows 7 to 12 years, and then we have recessions, problems, complications for anywhere from 6 months to 3 years. And then COVID gave us a new statistic of just 2 months for a recession and a related bear market. So this is a prior PPI when I said, hey, we got to have an alert if it goes above 3.5. Well, it just blasted through it to 4%. We're on to 5%. So there's the old forecast to show you I was all set up for it. And today I'm giving you an alert. We got the CPI ahead of the PPI by a few days, which is a bit unusual, but that's because of the government changing all this stuff because of Trump when we get this data. This is a long-term chart of PPI, and you can see it's taking out these prior highs. There's the COVID slam up, slam down, transitory, this and that. Now it's kind of like maybe something more subtle of an uptrend, but I think more sustainable for longer, okay? But what if it actually explodes, all right? This is PPI month to month, and it was unchanged so far this year. It's been at 0.5% every single month of moving higher for PPI. And this morning, the stock market got all excited to putting the price up more in the stock market because that 0.5 was actually a little less than what people were betting on in terms of the pollsters, okay? Now, I think they made a mistake there, and they may be waking up to that right now, that they should also be focusing on what is the annual performance. And the annual performance, that chart looks ugly, like inflation is exploding, okay? The 0.5 is telling us that businesses are just kind of like methodically saying, okay, we raised our prices 0.5% last month, we're going to do it this month, we're going to do it next month. So at least they're not panicking, and they might even be getting hurt still that they're not raising their prices fast enough, but they're also trying not to hurt their demand, hurt the economy, this and that. So granted, that's an orderly thing, and maybe the stock market likes that, but it's kind of ignoring the fact that if you look at it on an annualized basis, hey, this thing's speeding higher actually, all right? Let's talk some super long-term of inflation. The Kondratiev cycle struck in the 1970s. I call it 54 years. People call it anywhere from 54 or 45 to 50 to maybe up into the 50s. My 54 might be a little on the long side, but it's just a label, okay? So you get about twice a century, and maybe ideally even three times, beginning, middle, and end. But it was discovered by Kondratiev on wholesale prices. He later took it as far as, in theory, predicting the 1920-1930s crash, and the communists loved him. He was a Russian in communist Russia, and but he later said that capitalism could probably fix itself, that things would go right back, and they didn't like to hear that. They wanted an end of world story for capitalism. He refused to do that, wound up in prison, and became sick and died. Okay. Kondratiev, you don't hear about it lately for some reason. Some of the commodities people are getting more excited about it. Some people think we got a big super cycle inflation or commodities for a few decades now, won't peak out to 2050s. I'm not quite in agreement with that. I think we've changed some massive demand changes here. But the way I look at Kondratiev, if it was 1970s, this is it. It ought to be 2020s. Maybe I don't understand it's 2030s or something. And another thing, though, I'm concerned is it might not be as explosive as the 1970s. We can manage it a bit different than the 1970s. So you can see the 1970s, we put inflation up early part of the decade, and the stock market collapsed like 70%, 60%, something like that. Then you slammed down inflation mid-decade. Then they slammed it right up into the end of the decade, even higher still, but the stock market didn't go lower. It had pretty much beaten up enough the first time around, was dealing with it, learning how to make money out of this inflation stuff, okay? Then we got serious with Paul Volcker to kill inflation, and basically also had to throw ourselves in a recession to help kill it. Well, if you look at what's occurred here for early part of this decade, we had a slam up similar to what we've seen in early 70s. We brought it back to mid-decade, also similar to the mid-decade of 1970s. So some people are overlaying this inflation with this inflation and saying it looks scarily like the 1970s. So they're saying it's time to move up. Well, we just took out these recent highs here. From a trend following perspective, you got to be positive inflation, bullish on inflation. It's going higher. Throw in the business cycles and even more so. Well, anyways, I just gave you a Kondratiev super cycle top, but on that 2009 crashing moment, okay, that was actually an SC2 cycle of about 70 to 90 years. I don't use the Kondratiev for bottoms. I only use the Kondratiev for tops in commodities and with inflation, but I don't even use Kondratiev in the overall economy or stock market. There's something a little weird, and I can't explain it. It takes a long time to explain it. I think things shift a little bit differently, and things have evolved into the more modern markets. There's also a possibility for inflation that SC2 was actually in the COVID. It depends what data you're looking at. But this specific chart, I'm just using the lowest, the worst there, okay? Now, inside of that, we get a juggler business cycle, okay, that occurred from 2009 into COVID, and we had a recession, and we bring the inflation down. Normally, we bring inflation down with a recession, a depression. The U.S. is more oriented to deflation, depressions, recessions. Some countries are more oriented to inflation recessions, okay, or a mixture. Maybe we get a mixture this decade, something towards the end of this decade, when we get a much lower stock market and a recession, but we might learn there's actually higher inflation, or it's stubborn, it's staying rather elevated, right? I kind of doubt it. I think we'll crush inflation right along with the economy and the stock market. But what the model is suggesting is this top, this decade seems too late for a juggler. It's about 2 years too late. Maybe that's a mistake, and I just have to allow things that can't be that accurate. If that's a juggler top, we may not see inflation go much above 5% on this CPI and just kill it and knock it down, and we have the tools to do that. But something I want to consider here is that may be just a Benner cycle. In the stock market, we call it LT2, and that's like a halfway point. And what this would mean is we probably just put a Benner bottom in, and now it's time to go from the Benner up into the true juggler top late this decade, which would be more in line with the economy and stock market. But it also would suggest we can revisit the 1970s. Maybe later this decade it won't go higher than the first run-up inflation. I can see something different about it. But the point is, this might get crazy. I think we're on our way to 5% or better inflation in coming years. Do we do it now into next year? I don't know. But for CPI, I'm looking for 4% now into next year or higher, right? And this that's for the CPI. The PPI, I'm looking for 5% or higher, okay? Now, this chart was just another chart of the producer price index that I have forecast before, and then I already touched base. That's the new alert. And then this is another CPI, and yearly instead of a compressed monthly. It goes all the way back to 1912 or 15, something like that. And same story here. There's this year starting up on inflation, picking its head up. I think it's time to consider on the CPI even something even above 5%, which would probably put the PPI even higher. So the PPI started the up move, and I think that's normally how it works. The producer says, hey, I got to get more for prices. That's all there is to it. Then it trickles all the way to the store, to the consumer, that raises CPI. And these reports came in backwards of what I would normally expect. Doesn't matter. They're both showing the same things. Basically, PPI started up, CPI is following, and now we know with all this oil business that even if they bring down oil quite a bit the next few months, it's probably coming down slower than it went up, and that's going to raise the average price. That can still help out holding gasoline up somewhat. It doesn't, in other words, it won't crash. Therefore, it can't help lower CPI that much. Then what also happens is this higher gasoline and oil price just trickles through all the other products and through all the business. Yes, indeed, I'll stay with my forecast. We've got rising inflation in the next year unless the Federal Reserve can come in and kill it sooner. And the problem is we're going to get a new leader for the Federal Reserve next week. They're going to start grilling Warsh and see if he's going to make it in, and most people assume he will. And the point is, there's risk they're going to screw things up and allow higher inflation while they also try to keep the economy from falling apart by possibly lowering interest rates even while inflation goes up, or at least pumping more money, printing more money. And that can make the inflation worse for a while before they finally say, okay, we think we've saved the economy. Now let's work on killing the inflation. We got the ability to do that. But in the meantime, the consumer isn't going to like it. You and I aren't going to like it. And eventually, maybe the stock market's going to wake up and not like this as well. Again, an alert, inflation's going higher, and we got additional evidence today. Thank you.